Good morning. We're back again with tax incidence and elasticity, and today we are going to look at the impact of tax incidence when the demand for a good is relatively more elastic than the supply for a good. And that's a good thing to remember, is that it's not the specific elasticity of demand or supply that is determinant here. It's the relative elasticities of those two. So in this particular case, demand is more elastic than supply. And we are going to take a look at the incidence of a tax, or how the burden of that tax is split between the consumer and the producer when we place an indirect tax on a good. So let's go ahead and show our indirect tax in this marketplace on the suppliers of a good. And what that's going to do is it's going to shift the supply curve vertically by the value of the tax. The tax is an increase in the cost of production, which will not allow the supplier to supply as much. Taxes are a determinant of supply, and it will shift the supply curve. So let's go ahead and impose our tax on the marketplace. And there is our new supply curve with the tax that shows a leftward shift of the supply curve and a new equilibrium price and quantity. There's our Q tax figure, and there is our P tax figure. Now, we can clearly see that this is an elastic good because the change in quantity demanded is relatively larger than the change in price, so that consumers are clearly sensitive to the change in price of this product, and their quantity demanded significantly reduced as a result of a small change in price. So let's go ahead and identify the value of the tax so that we can see at our new equilibrium who's paying for that tax. So the value of the tax is the vertical distance between the two supply curves, which is noted right here at the market quantity. And we're just going to note this over on the axis as well with a new indicator. So I'm going to use P0 over here as our indicator. And so we can note that the value of tax is P tax minus P0. All right. If we go back and we look relative to our old market price, we can see that the consumers are paying a higher price for this product in the marketplace because they now have to pay P tax. But we can also see that this particular price did not rise by the full value of the tax. As a matter of fact, the price increase was very small relative to the tax. We can see that the producers here are picking up a much greater portion of that tax because of the nature of the good. This is an inelastic good, and if we think about the determinants of the price elasticity of demand, splat, right? This good might have a lot of substitutes. It might be a luxury rather than a necessity. It might take up a very large proportion of your income. It could be non-addictive, or you might just have a lot of time to make the choice to buy this product or not buy it. So the elasticity of the good is really significant. So the producer does not have the option of passing along that tax onto the consumer because they know the consumer is going to just rotate into a substitute or not be required to buy the good. All right. What we notice here is we notice a significant loss of market participants relative to what the market would do. And that is a lack of social efficiency. This tax is getting in the way of the price mechanism allocating resources to society's best uses. And what we see here is that we see a whole bunch of demanders that were removed from this marketplace. Those were people that at the market price would have participated, but now at the new tax price are unwilling or unable. And every time you remove a demander from the marketplace, we also remove that supplier from the marketplace. And what we find is we have that area of lost consumer surplus here, lost producer surplus here, And the combination of lost consumer and lost producer surplus is deadweight loss. And so we see in this particular case, we see that the producer is the one that is garnering much of the deadweight loss simply because the consumers weren't really all that intrigued by this good or service anyway. We can tell because their demand was relatively elastic. Leaving the marketplace for them is not such a big deal because of the elasticity. Leaving the marketplace for the seller, on the other hand, they're losing consumers. If we go back and compare that to our relatively inelastic demand, we can see in this case that the lost consumer surplus is significantly bigger than the lost producer surplus in this case because of the relatively inelastic nature of the demand, where these consumers really want this good in a much greater way. So, when we're thinking about the ways in which the incidence of a tax can be important to economic decision making, what we can remember is the outcomes that we're looking at. If you are interested in removing participants from the marketplace, what you're wanting to do is you're wanting to tax inelastic goods because small changes in price are going to create real sensitivity in that quantity demanded, and it's going to remove people from the marketplace. If you are instead looking to raise revenue from a tax, you want to keep people in the marketplace and you want to charge them the tax. And therefore, you would probably want to tax inelastic goods. You limit the amount of lost surplus, you raise greater levels of revenue, and you can use that money to then try to mitigate the reason you were taxing this thing in the first place. So there is your explanation of tax incidence for an elastic good and a couple of places where you might want to think about policy choices surrounding elasticity in taxes. Thank you.